Good afternoon and welcome to the EQTEC PLC 2021 Annual Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. It can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to David Plumbo, CEO, Jeffrey van der Linden, COO, and Nauman Babar, CFO. Good afternoon.
Good afternoon.
Good afternoon.
Good afternoon.
Well, first of all, welcome everybody to our 2021 annual results and 2022 outlook investor meet company webinar. We announced yesterday, the 25th of April, the 2021 full year results. This is following the completion of the audit through Q1 with the independent accountants and advisor Grant Thornton. The purpose of today is to update you on 2021 results inside the context of our broader strategy, and also to give you some insights on our 2022 outlook. We expect this time to take about 40 minutes of presentation, followed by 20 minutes of Q&A. And we also want to apologize for our CTO, Joel Aleman, who would like to have joined us, but today is in Croatia with Marcos Klunji, our managing director there, looking on site, visiting the projects. So Nauman as well.
Yes, yeah, thanks very much, David. This slide has actually been shared with our shareholders before. The purpose of this slide is to go through what our target state is going to be and then walk our way backwards as to where we are currently, because hopefully that would give you a bit more context. The end state, what is the end state for EQTEC? The end state is to become technology licensor and innovator. If you take example of some of the biggest software companies across the globe, they are best at innovating and development of the software, whereas their partners actually go ahead and implement the solutions in various geographies and markets. So what EQTEC is doing right now in order to make sure that we get to the target state is, first of all, we are setting up our go-to-market structures. We have seen that across various geographies where we want to make sure that there's a good local team in place. There's a big pipeline of projects that we can implement our technology on. And if we can have a proof of the plant in the shape of an MDC, then we would implement that. Right now, we are in 7 markets, US, UK, France, Italy, and some of the other markets as well. The second way we are going to get towards our target state is by harnessing relationships and linking up in terms of partnerships with some of the tier 1 partners, whether they are across the delivery spectrum or across the solutions and development spectrum. One of the examples is, we are collaborating with the likes of Wood, as you have seen before. Hopefully, we are going to kind of work towards more partnerships like that and also take them further in terms of developing our solutions. And the fourth thing that we are doing is to ensure that we have not only just the necessary ecosystem around technology licensing piece, but also all the pricing models and the architecture that you need, be it from a legal perspective or from a technical perspective, in place. So that is obviously going to be the target state. Where are we right now? It's very important to understand how we are embedding the right things in order to make sure we get to the target state. So we are establishing our MDCs, the market development centers, which are proof points of our technology across various geographies, across various applications as well. We are building a platform that will support growth and ensure that we scale. Go-to-market structures being one of the examples I quoted earlier. We are also linking up with engineering and project management partners. We are ensuring that we have our own engineering and development and project management capabilities in-house, as well as leveraging what our partners have to offer. And last but not the least, we are establishing and executing a digital strategy for advanced technologies to ensure that once we do get to that target state, we have a modularized build, and we are using our digital strategy and analytical capabilities to deliver what we want to deliver in terms of shareholder value. with that, I would hand over to Jeff to take us to the next slide, which hopefully would provide a bit more context around how we're moving where we are right now to the target state. Over to you, Jeff.
Thanks, Suman. I mean, one of the events we did announce in the annual results that I think we should celebrate is Noman's joining the team as the CFO. And one of the things we've been working on with him in that role is to start to look at, given the roadmap that Noman just reminded us of, what does that journey look like in terms of the revenue streams that we currently have, the revenue streams that we want to focus on in that end state, and then what's the transition from here to there. And this slide tries to bring that to life. You may recognize it as well from the annual results where we did put it in there. So we've looked across those revenue streams. And as Noman said, our target model is that of a technology innovator and licensor. That model is going to be one where we have maximum strategic focus on what we do best, which is to develop, improve, innovate leading edge technology and make it as available as possible to as many owner operators as we can around the world. However, to realize that model, we have to build that market. Where we are right now, that market does not yet exist, and we are going out and having to build it. What David, I think, earlier this week called the commercial infrastructure underpinning it, which effectively will allow us to grow a licensing network. That's what's going to transport us, if you will, from where we are now to where we want to be in the future. As of 2021, there are three key sources of revenue for EQTEC. The first one is project development services. Those are the fees we collect for the work that we do to gain planning and permits, negotiate commercial terms, secure funding, select engineering and construction partners, and drive legal execution. Those are payable at the sale of the special purpose vehicle or the project code that has been set up for that specific project. And we can sell it as early, we want to sell that SPV as early as we possibly can, preferably prior to financial close. And we'll come on and say more about that later. The second area that we focus on is, of course, our heartland, which is the technology sales and services. However, right now, we take payment for design, specification, manufacture, quality assurance, and then delivery of that equipment, the construction advisory that goes with that, and the commissioning of the plant itself, all through a single payment, or I should say a single series of payments between financial close and the commercial operations of the plant over the construction and commissioning phase of work. That is something that we will look at starting to unbundle, and we will charge for those earlier and more often, if you will. The final area that we have in 2021 is what we call other, which really includes maintenance services on existing plants, a certain amount of consultancy, and eventually, though, that will grow considerably, as we get revenues from market development centers, but more prominently as we start to charge for other types of services through the project phases and also, more importantly, through the O&M phase of work. So shifting along that spectrum, as I say, is going to involve us to start to unbundle some of what we're doing now. I should add that the reason we're charging for that right now in the way that we are, in a very kind of simplistic way, is because our number one focus is getting plants up and running. As Noman was just saying, these are demonstrations of technology capability in a variety of environments in our market development centers, and our most urgent requirement is to get those up and running and clocking operating hours. So that's the way we've done it. But over time, we will begin to transition that. We'll come on and say a little bit more about that later as well. David, over to you.
Yeah. So, just a second. So I think what is very important for our strategy is to explain why we choose which projects to take, to catalyze to financial close or to move them to the next phase. So it's very important that at the moment, as Jeff was saying and Noman said at the beginning, we appear to be a project development company. The reason why we choose which projects we catalyze, either by being co-developers with our partners or which one we accelerate to prioritize in our pipeline, is for a number of reasons. And the simple framework that we use for select this project is either because a specific project will help us work for new solutions, then that could be from the feedstock angle or could be from the application angle. And doing that, we can onboard new partners. We can develop new go-to-market with those projects and use them to be able to galvanize that local team, a local team from the local ecosystem plus the go-to-market and the customer base. The other reason that we choose a project or a criteria to use a project is they help us to show or demonstrate a technology solution that we have not implemented before, or a technology solution that we want to scale in a specific go-to-market. And that goes as well as we evolve this, we will also look into more digital capabilities that we can bring to these projects. Then once we have demonstrated successfully in a market an application, for instance, biomass to CHP, and as we have done already in several go-to-markets, we use the go-to-market and the local business capability, or like Jeff was mentioning, the commercial infrastructure to grow the business in that geography. And then from there on, we can build the network and we can shift more accountability to those go-to-market entities, to those local partners, the delivery partners, the funding partners. So we just take more of a P&L analysis of those go-to-market entities and a lot less of an operational involvement on those two markets. And that is, to us, the final stage to what being able to then become our first licensor or licensing channels for our technology. The projects that we have now in our pipeline are aimed to grow the existing solution or demonstrate new ones. So if you look at the pipeline now, for instance, in the US, we are growing the biomass to CHP with biochar also offtake, and we're looking how can we rapidly scale and grow this across California with an eye to other states with similar characteristics. All up north and south of California, you have all the 5 states where you're using the forestry waste as a feedstock-driven solution to address a local problem and produce an output that has a high market value. If you look at, for instance, in the UK, we're looking to demonstrate the first commercial scale RDF to CHP or RDF to power and heat, and also RDF to hydrogen. So a number of the consideration that we took about reconfiguring, the project in Billingham, the D-side and Southport, it was how can we put a capability to do RDF to hydrogen or RDF to synfuels in projects where we already have a local offtake and where we will attract, by doing so, different strategic partners, different funding partners, and all those decisions are based on our strategy and how we can use the specific project to leverage on that strategy. Then when you look at France, we had on an R&D facility, we have demonstrated the capability to do contaminated plastics. We'll have soon publishing the result of that test. They're being translated as we speak. Very impressive test for contaminated plastic and RDF as well. That catalyzed the relationship with CEPS. So now in France, we're looking to demonstrate from a feedstock-driven application of contaminated plastic, but also we're looking at most of the projects we're developing in France. They are biomass to synthetic natural gas. So that's the value of the French pipeline now for us into that strategic context. And then when you look at Greece, again, it's biomass to CHP and biochar application, but the focus in Greece is small-scale agricultural waste streams. And that's a very interesting market in the other countries in Europe, but where at the moment in Greece there's a lot of demand for those small-scale plants. And then when you look at Croatia again is biomass to CHP and biochar application, but the focus in Croatia now is a lot more about mixing different type of biomass with industrial waste streams and also local industrial offtake, like in the project in Belize, and we're looking now the same thing in the project on Canada. Then other thing that we'll add in terms of that is our R&D program on 2021, and we'll come to talk more about the 2022, also is in line to support that strategy. Everything at the moment, what you can see in the company is we have integrated, all the elements that are going to build that end state to be able to license the project. So in 2021, we do as we discussed before, the RDF contaminated plastic test. and we have expanded the capabilities of the plant in Lorraine, and we obviously have the collaboration with CEPS and the ability to now look at pipeline together with Wood and make the facility available for other tests of feedstock as well.
So when we spoke with you last time, at our, I think, Q4 results, we talked a little bit about our go-to-market verticals, which, obviously we've been referencing on this call. And we talked to you about how we're organized in each of those with, a managing director, a strong managing director and a team, possibly a market development center, and hopefully one in every single market we're targeting. We talked to you about several other elements. One of the areas that's a particularly important focus is partners. We want to develop, and we have developed, strong local partners in places like Croatia, like Italy, and so on. And in Greece, of course. We have built those partnerships because they can deliver locally, they have local relationships, they can build local teams very rapidly. Beyond that, we are also, from a group level, building multinational relationships with multinational partners, tier one entities. And the important thing about partners is, although we are building a go-to-markets in all the target markets we're in, and although those are either majority owned or wholly owned by EQTEC, they're EQTEC group entities, partners bring acceleration. Because partners do not just bring their brand and their track record, they bring capability, they bring relationships, they bring potentially pipeline, and they bring other types of investment and so on to bring to bear. So we have been investing heavily in development of more partners. And those of you who have known us now for several years will realize that we're building relationships with larger and better known partners. What you see on this page is the growing number of partners. This is not a complete list, but this includes a range of partners with whom we've announced formal collaborations, some of whom we've announced working directly with us on projects, and some of whom we're in conversations with, either about projects or about collaboration arrangements or both. So we're making a very significant shift in both the number and also the profile of the partners with whom we're working. And that's very important for us. It's important for us because it begins to bring much more recognition and awareness and visibility of our technology. It also brings along with it, such as the announcement of Wood last year, the credibility. As many of you know, Wood did a technology review at the end of 2020 going into early 2021. They also did a market review with us. And obviously, the outcome of that was a very close relationship with Wood and a formal collaboration agreement with formal governance, a shared pipeline to develop, regular monthly meetings, which are substantial, very content rich, and of course, joint development of integrated technology solutions that we will take to market together in one or more of the projects in our shared pipeline. And so, that kind of way of working is something that we're going to extend now to a range of other partners. It's worth saying that even partners like Wood that are technology partners are by their very nature also go-to-market partners. So if you look at the announcement of CEPS recently in France, that is a partner with a technology to remove a certain amount of contamination from plastics, but then we are able to take that, put it through our gasification process and produce a very clean syngas at a very, very healthy emissions, output. And therefore, we are working with CEPS not only at developing that joint solution, but also on expanding in the French market, where they already have a very strong presence. And we're delighted to find we have a decent brand through our partnership with the University of Lorraine. If you look at the announcement recently of Black & Veatch, Black & Veatch we've announced now in a relatively focused role in D-side, but we've been talking more broadly with Black & Veatch about broader opportunities in Europe and the Middle East. They have an EMEA, Europe, Middle East, and Africa, region, but also in North America, where they are arguably even larger than they are over here. We will continue to have these types of conversations, and we will continue to expand not only our ability to deliver these joint solutions, but also our go-to-market presence in a number of new markets where they can accelerate our development in them. Noman, over to you.
Now we have the context of the strategy in terms of what the target state needs to be, and the partnerships that we are striking. Let us now turn our attention to the FY21 results, which I'm sure a lot of the shareholders would have already seen, but it's important to mention some of the key aspects of that. So in 2021, EQTEC delivered 9.2 million euros worth of revenue, which is 410% of 2020 revenue, which is a significant achievement and a lot of hard work that the team has been putting in behind that. And directionally speaking, we are a revenue company at this stage. Obviously, we are growing our top line. We do also keep an eye on the EBITDA and the net profit/loss line to ensure that directionally, obviously, we keep that in mind, because our end state, obviously, we want to make sure that whilst getting there, we convert our losses into profits as we go along, but focusing initially on revenue, and that's where the initial focus is going to be. From a net asset perspective, if we compare 2020 with 2021, the net assets actually increased by around 71%, so a huge increase. A lot of that has gone into the patents, the investments, the development aspect in relation to the projects that we are developing both in UK and elsewhere. With regards to the revenue growth, if we compare the FY20 and FY21 numbers, we grew by around 310%. At the same time, from an OPEX perspective, our OPEX only grew by around 30%. So again, a quite healthy ratio from that perspective. Whilst we're investing into skills, capability, and capacity, we are growing our revenue significantly as well. With regards to the geographies that we're currently operating in, I think it's important to mention, obviously, our market development centers are cornerstone of our strategy right now, to ensure that we have the proof points in the markets and across various applications as well. We have been focusing on other third-party plants under construction as well. So there have been 3 additional plants that have been under construction in 2021. There are around 12 projects which are under development. So ensuring that we bring from pipeline the opportunities into projects, and then we deliver alongside our delivery partners and take them further. With regards to the future, obviously, we're establishing a platform for growth. As explained earlier, we are setting up the go-to-market structures, which are very much operational right now in Croatia, Greece, and some of the other territories as well. We are going into these territories either through joint ventures or establishing our subsidiaries or having our MDCs in place. We are striking strategic partnerships with the likes of Wood, Toyota, Logic, and H2 to ensure that not only we have the technology partners, but the delivery partners and future growth, the areas where we see the future growth, we are kind of linking up with regards to our partnerships with them. And at the same time, we have been recruiting the engineering and project management talent to ensure that we continue the project development aspect, which is very much an important part and parcel of our strategy. So all in all, a very successful year, and a lot of rigor with regards to revenue recognition from the auditors and so on and so forth. So that's just an overview of the 2021 financial performance.
Thank you, Noman. Thank you, Noman. So moving to our outlook for 2022, I just want to go back into the context of when we talk about show it, grow it, and scale it. So what for us is, what we expect for 2022. So we'll continue to apply our business strategy. It's a sound business strategy that has enabled us to adapt it as the market moves in one or other direction rapidly. So we'll continue to advance our solution business or our approach to be able to build projects with a group of partners that support that solution model, and also with an initial focus into digital. So for instance, when we talk about show it, we expect to have obviously live operations on the MDCs in Italy and Croatia. We expect to have a financial close of at least one RDF facility in the UK, and continue to advance the projects with plastics in France, with focusing as well in hydrogen and synthetic natural gas opportunities in the UK, France, and other locations. That's from a point of view of the platform. We will continue to. I mean, we early in the year we formalized the go-to-market in France. We expect later in the year to have one or more of Italy, Ireland, or a proper USA go-to-market, maybe for the East Coast, established. We'll see that we'll advance the wood pipeline that at the moment is close. It has 12 opportunities that we're evaluating jointly. Probably half and half, both by wood and half both by EQTEC, and start working with integrated solutions in product lines that we can develop together with wood and with the addition of new technology partners. So in 2022, you probably will see as well that we'll announce other technology partners, potentially other collaboration with more owners operators of this type of plants. Then in terms of digital, we will expand existing capabilities. We talk about one of the most disruptive things that we have is our computational model that allows to simulate all the reactions and to adapt the parameters before we even design. So we are working and investing more into that, into design and monitoring and control system that we already have, and to start developing that even as a product, as a product that can be in due course also sell into the market. We have developed a 3-year digital roadmap. So we're very clear for the next 3 years what we do, what kind of companies we're seeking to partner with. We're in discussions already with companies around artificial intelligence for procurement and from analysis of carbon emissions on the plant. We're also looking at discussion on alternatives technologies that we can use that are ancillary to ours. So there's a very clear 3-year roadmap into the digital offering that we can bring, and also how we can use data analytics to our advantage, particularly now that it's so important for carbon accounting and for measuring performance on energy and fuel plants. In terms of growth, in the growth phase, we will see obviously new projects in California, in Greece, in Croatia being advanced to financial close. We expect to look at the pipeline to develop potentially other projects with Toyota and other large industrial off-takers. We are also expanding the funding pipeline discussion with project funding investors, which is something that is critical to accelerate project to financial close. We have ongoing discussion with 4 or 5 European funds at the moment, looking at a broader pipeline that could be multi-country inside of Europe. And we also will see that to expand access to public funding, both in the EU, UK, and USA. We have very interesting discussions with obviously the BIS here, in the US with the Department of Energy, the loan program officers, and there's a lot of support for the technology, and there's now increased support for advanced biofuels as well, and gasification is a critical building block to that. The type of gasification that we do with the ability to produce the syngas to the specification required for the application is critical, and we're seeing a lot of interest in that. And then in terms of scaling, what we already have, from an R&D point of view, we expect to have after the summer the upgrade in the Lorraine University for steam oxygen gasification, which is critical for syngas to chemicals applications, particularly hydrogen and synthetic natural gas, and that will give us the ability to onboard new partners. We already have scheduled a new test in Lorraine for technologies that can use our syngas for very interesting and groundbreaking applications, using anything from bacteria into the synthesis gas to carbon capture. There's a lot of interesting new companies that are coming, drawn by the ability or the possibility to test in the Lorraine University a full configured gasification, both from air blown and steam oxygen gasification. In terms of around carbon accounting, we're co-developing with Ricardo, the engineering company, Icerto, a venture opportunity that we are nurturing closely, and Carbon Future. is the capability of how can we use artificial intelligence and use a simulation model for carbon accounting. And then we're developing now with the likes of Carbon Future and their network, a platform for carbon credit sales. This is something that we see is a market that is going to expand. I mean, you have the big, large corporates in California already after the carbon credits of most of the projects, and this is only going to become more critical as we move forward. And another thing in terms of scaling, we're developing alternative of pricing models. As Jeff was saying earlier about the revenue stream and how we move to a licensing model, we're looking at other new, not only revenue line, but how the real execution, the real world with partners about the licensing model. So we've been talking to legal firms, and we've been structured in the US and in Europe to look at IP protection, licensing, data protection, but also the fact that the most important thing that we have to cement the head start, the years ahead that we have for any competitor in the space, is to keep receiving the data from all these plants and being able to process the data and to use the data for improved design, use the data for improved monitoring and control systems, predictive maintenance, etc., etc. In terms of the
That's it.
In terms of I think this is the in terms of the outlook for 2022, and I think now we can move to Q&As. I know there's been quite a few sent to you to us to the platform, and some of them sent directly by email. So we'll try to in the next 20 minutes address as many as we can.
That's fantastic. Thank you, David. Jeffrey, Noma, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. David, we did receive a couple of pre-submitted questions. Perhaps we can start the Q&A session off with those, if I may. The first one reads as follows: what further actions can be put in place to speed up completion of projects to operational status to earn revenue?
Great. I'll get that Jeff to answer that question.
Okay. I think the first point, if I hear it correctly, the first point to make is that, of course, at this stage of our business evolution, the live operations of the plant are not the primary driver of revenue for us, right? So if you look across a 3-phase life cycle of the project in terms of project development to financial close, construction and commissioning from financial close through to COD or commercial operations day of the plant, and then beyond that through the life cycle of the plant over whatever, 15, 20, 25 years of operation. Right now, going back to my point on revenue streams, the vast majority of our revenues are at the front end of that life cycle. The story of the evolving story of this business is it'll eventually be towards the back end. So right now, our primary revenue streams are the 3 that I outlined. Number 1, project development services themselves. We are a project developer. We will not be for our entire history, but right now we have a specific project portfolio that, for the reasons David outlined earlier, we need to deliver in order to demonstrate the technology capability, then grow the number of plants that operate that, and then ultimately scale those. And so that's the way that we're configured. So the development services are one, the technology sales, which I mentioned we'll be unbundling over time. And then the third one is other, which is a mixture of kind of maintenance services and other revenues from our own operational plants, eventually the MDCs and so on. So really, in the near term, let me answer the question in terms of the near term. To support revenue generation, we're taking sort of 3 sets of actions. Number 1, we're going to reduce the risk and increase the quality of how we do project development and how we do construction and commissioning work by partnering with the best partners, whether they be tier 1 or they be local partners such as Cosmi, we have in Italy and other parts of Europe, with whom we can work very, very well and will do a very good quality job and, of course, enrich the brand of the business. Secondly, we're building a pipeline of funders, and that will include, as David said, owner-operators, real asset and infrastructure investors, and then kind of other fast-moving investors like family offices and so on. And all of those are going to help to build that out for us. it's critical that we get that funding set up so that we can move quickly once we have new projects to get the funding in there. The third one goes back to what I was saying about the unbundling, right? We need to now stop waiting until financial close or beyond to later on in construction to start bringing in revenues. This gets easier as we mature as a company, as we become better known, as we have more projects. But what we want to do is sell the SPV earlier on, and then bill the SPV just as any other engineering company would for the engineering work that is done as part of development or that is done through the construction process. So those are the three things that we're doing to kind of drive that forward and generate revenues kind of more often, and more reliably.
And just to add to that, I mean, some of the projects that are coming already to us, like in France with higher profile owners operators that already have the infrastructure, we never own the SPV. Of course, they're already coming to us for concept design, for development services, to catalyze and to mature the project. And those are projects that we can invoice immediately with services before we even reach the point where we can do technology sales.
Fantastic. Thank you very much indeed. The second question we have here is, why was the CLN financing needed? Where has the cash gone?
Great question. First of all, I mean, I've seen a lot of different chatter of that on the retail boards and all that. First of all, convertible loan note is what CLN stands for. This is not a convertible loan note. This is a short-term finance facility that is there for us to pursue and continue to develop the strategic projects while we either sell the SPVs or we take some of these projects to financial close and we have the realization of those sales. The capital is being deployed ongoingly as targeted, as a discipline, as we deploy in the capital of anything else that we do, most of them in assets. And any payments in share are fully at the company discretion. And if you even look at the performance fees of these loans, they trigger at, first of all, not for the first 3 months. The first payment starts in August. And also they trigger only if you have a very high share price appreciation. So they start being triggered from the share price doubling, then the share price going 50% above that, and then the share price tripling as well. So we're talking about the company having a market cap of close to 300 million, and to making an additional payment of even 1 million in shares, it'd be minimal dilution. Everyone likes to talk about dilution, either by a placing, either by capital. It's very common for a fast-growing company to find alternatives to equity to capitalize themselves. And venture debt is what is available for companies at our growth stage. The important thing is, how do you use that capital and how well you deploy that capital, and you don't use that capital to keep the lights on. This is something that we have very clear. Our numbers show where are we deploying the capital. Also, given the volatile market that we continue to see in 2022, it's prudent to have access to capital, both for tactical opportunities, but also as a buffer through revenues and realization of the sales of these SPV sales. So, always in the market for alternative to equity, and we know the lenders quite well. We have a long history with them, and there was we find it like the right thing to do.
Fantastic, David. Thank you. If I may just ask you to click on that Q&A tab now, and just perhaps start at the top, and where appropriate to do so, if you could just read out the question and give your response, or pass it around the team where it's appropriate, that'd be wonderful. Thank you.
Yeah, we'll just dig in, because we're we often say we're blessed to have a very actively engaged shareholder community. So we want to get through as many of these as we can. And I think it's worth saying, our commitment to you is, as it has been in the past, that anything that we don't answer or we run out of time on, we will answer through the IMC website and/or through our own FAQ on our own website, or both probably. The first one up here I see is, could you please explain what a go-to-market solution is and what the difference between it and your other business model? Yeah, thanks for asking that. And thanks for keeping us honest on our jargon. We don't want to get too wrapped up in our own jargon. When we talk about a go-to-market solution, first of all, let's break those two apart. For us, a go-to-market means, how are we taking our capabilities to customers, ultimately? And ultimately, those customers for us will predominantly be, we hope and believe, owner-operators. In the near term, our customers include a broader set of people, but it's how do we link what we do with what they want? And so right now, we're going to market through geographies, right? So we have a go-to-market into France, we have a go-to-market into Italy, we have a go-to-market into Greece, etc. So those are our go-to-markets. Now, in the future, we might go to market through for example, a solution. And a solution is a combination of what kind of feedstock do you have? What are you trying to do with it in terms of offtake application or applications? Roughly what size is it and what business model does it follow? So let me give a couple examples of that. And I think we started talking about this sometime last year a little bit on LinkedIn and other areas. So there's some very interesting ones. The one we have in California is interesting because we've got a pipeline, a very large pipeline there of potentially identical plants, in so much as they all have forestry feedstock. They're all 2 to 3 megawatt in size. They all are probably, at least right now, going to produce biochar because there's a very strong market for it in that part of the world. And then they're also going to produce either combined heat and power or potentially other types of sim fuels or hydrogen or synthetic natural gas or something as an application. And why that's interesting is that they're all in the same state and their primary focus is on the prevention of forest fires. Now, that's a very interesting business proposition. And so what we're trying to do there is say, what's the business solution there? What's the go-to-market solution? It is build the plant once and then replicate it as many times as you can, lower the incremental cost per plant, and therefore improve the incremental margin per plant. And also try to avoid having to resell it every time. Get the state of California's backing, get a set of funders interested in funding, 3 or 4 or 5 of them, and then replicate that again and again in multiple areas. So what we're trying to do there is move quickly to deploy that business model. Another one we often talk about is one that we're kind of looking at up at D side with Toyota. We found an offtake partner there who wants to buy the offtake from the D side plant, and then we want to replicate that kind of dedicated industrial offtake. So that kind of go-to-market solution for the industrial on-premise or near-premise type of facility is one that we think we could replicate. So it's early days, but as we learn these things, some of these will be winners for us, some of them won't be, and we'll move to where the winners are. Hopefully that answers the question.
Thank you. I'm looking at another question here in the Q&A. We go Lacey. How do you expect the margin profile of the business to change over time, given your anticipated revenue progression? You want to take it? I can take this one. This is as we say. I mean, as we move more to high value services, the margin, obviously will increase. I mean, we will see probably to a certain extent revenues. The proportion of the revenues will shrink, but the margin will double. And when we move to license, to be honest, it's mainly pure margin on the established application. We will see that already in some of the project in France, where development services come from methods and tools that we already have, or libraries that we already have of concept solutions that we can provide. And then we expect our margins as the projects, as we move more towards a licensing and a value-added service model, we see our margins going increasing significantly.
There's another one here I see about, can we expect an announcement of an offtake agreement soon on any of the UK plants? Yeah, and I think there's a number of questions about the UK projects and where we are. You'll recall that we deferred the 2 of the UK projects at the end of last year, precisely because of the offtake opportunities. So this is a particularly relevant, obviously, question. I think what we've learned in the UK plants is the development of these plants. We have dedicated teams, we have expert teams, we've got extremely good focus on these plants, but the development of these is going to move as fast as they're willing to go. And we are working in an environment where we are taking in a technology to work on RDF. We are taking in a technology that has a huge versatility, which is in the long run a blessing. That it's a big part of our proposition, but in the near term, we have to try and provide as much focus as we can so that we don't confuse investors, potential investors, about what it is that we're trying to do. Now, let's talk about each of the projects. We have the one in Billiam, where we are in the middle of Teesside. It's a heavily industrial area, and what we found there is the combined heat and power, for which we already have got the permits, we already have got the grid connection. It simply isn't a very compelling and interesting proposition in that part of the world because bigger things are happening. Many of you will be aware about all the development in that area around a hydrogen network. In the near term, they're looking for potentially a synthetic natural gas until hydrogen becomes really viable for a number of those areas. And so we've gone back and rerun financial models so that we can find the best possible solution for us there and for others in the area. We are in touch with the Tees Valley Authority up there, who have brought us literally dozens of potential offtake customers with whom we are now talking in the Billingham area about potential offtake. And what we're trying to do is land on the best solution for them, for us, and for our partners in terms of delivering that piece of work. Do you want to talk about Deeside and Southport?
Well, all I say, I mean, I'm conscious to take a lot of the question. All I'm saying is that by changing this configuration of this project, we are broadening the potential of taker, but we are also broadening the strategic investor that would be interested to the site. Even when you have only combined heat and power, and you say, listen, you're going to go from a 9-10% IRR from incineration with all the negative emissions, or you can go to a 12, 13, 40%. That's not enough. But when you actually say, but we can also produce hydrogen, we can also produce synfuel, suddenly you have a much broader investor base. So I think the offtake, again, this is all back to in the presentation we're talking about the strategic selection of this project and which one we can bring to financial close first. The one question I think is useful because it's very topical. Everyone should be interested about that. Has any of the project IRR improved significantly with electricity and gas price? The answer is, in the long term, yes. I mean, we have seen already electricity tariff in the short term. If you get 1 to 3 years contract doubling to what we have in the financial model, and gas price, is even more aggressive than that. Having said that, what we are balancing now as well is the supply chain cost and increase in the commodity prices and labor and all of that have also taken a lot of that additional margin. In the long term, we'll see that the supply chain probably will decelerate the inflation and the energy price will continue to accelerate, particularly from alternative energies. But that's another reason why we need to be vigilant and also tactical in the current market on those projects. And in terms of if you accelerate any project to financial close in 2022, you're going to get some of the construction costs that are going to take most of that increased IRR as well. So there's a tactical reality and a strategic view that we need to have on every single project that we take to financial close.
Before we go into the next question, I just want to apologize on behalf of Noman, only because he's having some connectivity issues on his end. So he may be coming and going. We'll press on. There's a long delayed project in Ireland through Carbon Sol is the next question. Have you seen any more progress in the planning situation over there? What is the cause of the holdup? And do you have a timeline for that project? So yes, I mean, Carbon Sol were with us last week in our offices here in London. Sorry, it was 2 weeks ago now. Time flies. And we met with 3 of their key people, one of whom has joined in the past year as what we call a project development manager and a very experienced developer of infrastructure projects who is going to take the lead on the development of those projects with Carbon Sol and with us. That is a great sign. It's very in line with our model here for how we deliver our projects as well. So we expect to see great pace there. We are now in what they call the concept phase. That concept phase will take us through probably until Q3 of this year, which would say then probably after that we have 9 to 12 months to get into a financial close. None of that, please realize, is guaranteed. We could move faster than that, but much of it depends on how quickly we can get together the resources, the partners, the funders, and so on to make that happen. But we very much still, as we said in our annual results, have an intent to operate in Ireland with Carbon Sol and a very exciting pipeline that they have.
Yeah, I'll just add to that. all 3 projects on carbon soil and an exact carbon copy for the planning application from all of the environmental tests. So we will be, this is something that can accelerate once you get the first one through. And to be honest, we have a lot of support from the local and central government in Ireland. It just is the nature of how planning happens in Ireland.
We have another one here that if Noman is with us, Noman, speak up. When do you expect to be EBITDA positive?
That's a very good question. I think it's important to indicate the fact that, if we compare the FY20 and FY21 gross margins to start with, it was 11.4% in 2020 and 17.8% in 2021. So directionally, as I indicated earlier, we are a revenue growth company. So our focus is going to be on growing the top line whilst investing in the skills and capacity and capability within our teams. We are targeting more towards being EBITDA break-even to EBITDA positive this year. However, it is all subject to how the projects pan out, and there are a lot of factors riding on various elements. But as I said earlier, we do keep a very close eye on our gross margins, especially vis-a-vis the revenue numbers.
Great, thank you, Noman. The other question could be, are there any geographies you are focused on expanding into, or is your focus more around finding the right partners and/or technology? I think this is Jeff addressed this before, and also we talk about the projects. The geography that we've been attracted to, I mean, we've been attracted there by a pipeline. It's a pipeline in the geography, and then we'll find all the elements that catalyze that pipeline. Obviously, Europe is much easier to deliver in terms of not calls 8-hour different time zones. But putting that aside, as we develop with the partners these local solutions, or is the explanation that Jeff made about go-to-market solutions, then this solution can be deployed globally. And I will say that the focus is in the right partners and the right, both from a technology point of view integration and from a delivery partner, than just a geography. I mean, another thing to say that Jeff also touched on, when we build a project in the UK with a Black & Veatch or with a Technicals or a Petrofac or any of the potential EPCs that we're discussing, that they have the capability to deliver these projects in Asia, in the Middle East, where we have huge demand coming from, but we are also waiting to be able to have the delivery partner in the area. So it's very much partner driven to that question, Lacey.
Yeah, there's another specific question here about the UK Department for Business, Energy and Industrial Strategy, or BEIS, published last year. It was entitled "In Advanced Gasification Technologies, Review and Benchmarking." Companies like Powerhouse Energy Group and Velocys were included as known gasification technologies. Any idea why EQTEC was not mentioned in this? Yes, thanks for asking. We've got a very clear line on this. I mean, first thing to say is that we've been in touch with BEIS since that was published on multiple occasions. We have an upcoming meeting with the energy secretary or the energy minister, to follow up on this. We have got a number of meetings that we've reported to you in the market on meetings with MPs, and we've been mentioned on the floor of the Commons as well. In my personal point of view, I think the oversight has been acknowledged. What I would say is that the report was explicit that all of the companies mentioned in that report, or I should say the other way, none of the companies mentioned in that report have commercial operations with gasification. Since then, BEIS has also said that gasification is their preferred technology for advanced biofuels, for hydrogen, and so on. Despite that, they've also said more recently that they do not believe gasification will be viable this decade. That represents a big opportunity for us, and it goes exactly to what David was walking us through in terms of what we need to demonstrate now in the UK market. It is the reason that we have these projects in the UK market, and it's the reason that we're investing in demonstrating that EQTEC technology is viable, not just for biomass, which we've already demonstrated, but also for RDF, which, although we've demonstrated that in an R&D capability, we have not yet created a commercial plant that's up and running. So we see this as a great opportunity for us. In fact, we've turned what was a disappointment, we were disappointed as well, into, I think, a really great opportunity for us to pursue.
Yeah, I think that was some of the things that was the drive to also reconfigure the UK projects. I mean, one of the comments that they made is like, but we thought you only do combined heat and power applications because you don't have any of your pipeline those applications. So immediately we saw the opportunity to show that we can do that. And we could have a RDF to hydrogen or RDF to methane project before anyone else operating, because we have a site with planning that we are now reconfiguring for this. And that links to another question that we have from Adam that say, can you say more about steam oxygen trials and what the benefits are likely to be? Okay, the main thing here for air-blown gasification is what you use for combined heat and power, and steam oxygen gasification is what you use for synthetic fuels, natural gas, hydrogen, etc. The reason is because that gives you the ability to control the ratio of the components of the syngas. We will be the only ones who will have a steam oxygen gasification capability in Lorraine University this year, where we could prove to all the people that it's possible to use with the 60 different type of feedstock that we have to produce syngas to the specification required for biofuels. So that also, to try to address 3 questions on one and risking, talking for too long. That leads to the same question about how do this compare with the hydrogen utopia is doing in Ireland, and how we see it as a competitor. If I'm not wrong, I think hydrogen utopia has some kind of partnership with Powerhouse, which is basically, again, one type of feedstock to one application, plastic to hydrogen, and they're still yet to build the first plant. So again, it's just a matter of maturity of the technology. We are TRL 9+ on anything to do with air-blown gasification, and we have analysis of TRL already 7+ for steam oxygen gasification, which our team has already done extensively in projects going back to 2014, where we're doing the Polygen project, which was using RDF into synthetic natural gas. So, few years ahead, let's say.
I think we probably have time for one more. I'll pick the one here that says, what is your strategy for finding and retaining key engineering staff and the core skills you need? What does the recruitment environment look like today? There's a number of things we could comment on. Let me just try and name a few. I mean, the first one is that we, in our Barcelona technical center, we maintain what we call process engineering capability. And that includes people who do the control systems programming. That includes people who understand the end-to-end process. It's where we have 4 PhDs who are specialists, not just in chemical engineering, but in gasification, in particular, EQTEC gasification. That team is growing. We have brought in additional process engineering capability last year, which I think we reported, and we will continue to grow that team. But alongside that, beyond the process engineering, which is our core capability, to deliver these projects successfully, we also need mechanical engineering, electrical engineering, civil engineering. And for that, we have brought ourselves closer to our partners, CT3, who are based out of Madrid. They currently have, I think, between 50 and 60 engineers in those areas. But critically, they've been in operation for 30 years. But they have the ability to rapidly scale up and down that capability because they have an extended network across the whole of Europe. We're currently doing benchmarking work to ensure that we are paying and remunerating engineers in the right way, and that therefore we can attract the best talent from a remuneration perspective. That work is literally, we're expecting a report in this week that will help us with that. And we are looking at then how we integrate those teams more fully, both between the CT3 project engineering teams and our process engineers as well. There's something else I wanted to mention, but I forgot.
Just a quick one, because I think we have one more that is quite important. One says, what goes on your kinetic model software that peers new entrant will struggle to mimic? And what extent does this software de-risk the new project? Where does the software fall short versus reality? The first thing is 20 years in development and 60 different type of detailed data on the feedstock, and all the simulation algorithms that software has been developed in-house. So to this date, all the tests in Lorraine what prove is like whatever the simulation software tells us in terms of composition, tar content, ashes, etc., is accurate to 5% tolerance. That is groundbreaking. And the more tests we do in Lorraine, the more we keep proving that the simulation model is proved correctly in terms of that. That is very difficult to replicate without the library and the experience and the hours and the years that have been developed. But also that is disruptive because you are able to simulate and design the plant in a simulation before you commit to hard steel.
And sorry, just on that, you've now reminded me of what I wanted to say on talent, because it's linked. What the CTO and the team in Barcelona have now done is to build a training capability internally as well, so that some of the things that David was just outlining now will not be known simply to the team that develops and operates that, but much more widely, and not only within our company, but as we bring more technology partners like Wood and others on board, they will also be trained and they will be able to understand, and we can extend that capability to raise the level of understanding of EQTEC technology and how best to deploy it.
David, Jeffrey, Nauman, thank you so much for answering so many questions. And of course, if you have submitted a question we haven't got a chance to, the company will be able to review those, and we'll publish all responses on the Investor Meet Company platform. David, perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you, if I could just ask you just for a final few closing comments, please.
Yeah, well, as ever, first of all, we welcome all the challenge, the questions from our investor. We are blessed with not only an institutional, sophisticated institutional investor base, but a retail investor base that's very well informed, that pose very important, interesting questions. We take everything on board. We have taken the feedback to try to communicate even better, the strategy and what we're trying to build. So we thank you and we welcome more of that. And we're building a business here that we want all investors and stakeholders to be proud of. We're building a multi-billion business here, and it will take the time that will take. We'll adjust the strategy as much as needed to respond to the market. And I understand that, as Jeff said in the proactive interview, it's not been easy to be a shareholder of any small capitals, small cap stock in the volatility that we have seen in the last year or so. But if we're looking to, we are in the right market, we are in the right time for doing it. This is very disruptive what we're doing, and the scale is immense, and there's a real sense of urgency on deploying these technologies, both now from a point of view of the investment community and the government. There's going to be short-term turbulence. There's going to be short-term both governments and investors trying to find in their feet. They need to react very quickly at the situation, the geopolitical situation, and all sorts. But we are at the right time and at the right place. So we thank for the ongoing support. We'll continue to work. We have a very, want to thank the whole team at EQTEC. We have an incredible committed team that is really fully, personally, emotionally, and financially invested in the success of the company. And we'll keep informing you on everything as much as we can as exciting news comes on.
David, thank you very much indeed. And Jeffrey Nauman, again, thank you very much for your presentation today. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of EQTEC PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.
Thank you.
Thank you very much.